In February 2022, Charlie Munger had said that a bubble has formed in the stock market, so the reporter asked him, what could happen in the future? So Charlie Munger said that whenever there's a situation where the government prints so much money, and interest rates get so low, so very bad times are going to come in future. Now we do not know when it will come and how bad it will be. But friends, the interesting thing is that we did not need to wait too much for what Charlie Munger had said. In the whole of 2022, that is, from January to December, the US market has been going down, and according to some people US has already come into recession. And if there is a market crash in America, it will affect not only America but the whole world. Now the question arises that what can we investors do in this situation? Should I buy stocks, or sell, hold, or something else? And if we have to sell, then when and how? And if we have to buy, then which type of stocks? So friends, in today's video, we will discuss this step by step, how you can take advantage of the stock market crash, which has a lot of chances to come. And also understand why Charlie Munger said that there is a bubble in the stock market. We will explain it in detail, with examples in simple language, so that even a small child can understand it very easily. So let's start the video. So first of all, let us understand that what exactly is this recession and why it is coming again and again. Now friends, this is a very basic question, but it is very important to understand it well, because when the recession came in 2008, and in March 2009 Dow Jones was at its bottom, it was 50% below its previous high. Means imagine a beginner seeing the market going up, he invested $100,000 on December 2007 pick, and suddenly market crashed, and his $100,000 portfolio remains only $50,000, then how does that investor feel? You cannot even imagine his pain. So now the question arises that what happened in that 1 or 2 year period, due to which the wealth of all the investors gets halved. So friends, the answer is that usually the recession starts with some real reason, like in 2000 the valuation of internet company was high, in 2008 the valuation of real estate of US was high. But then later it becomes extreme because of us. For this I will tell you a story. Imagine there are 5 friends, all 5 have different emotional IQ, means James is the most emotional weak, he sometimes gets very scared and sometimes gets very excited. Then there is another friend William who is also emotionally weak but a little less than James. Then the third friend is a little emotionally strong, the fourth friend is even stronger, and similarly Jack, who is the fifth friend, is the most emotionally strong, who can control his emotions well. So in the beginning, when bad news comes for some reason, the most emotionally vulnerable people in the stock market tend to sell their shares out of fear, people like James, so their sudden selling creates a selling pressure in the market. That means suddenly more sell orders will come. And according to the principle of basic demand and supply, when there are not many buyers in the market and there are only sellers, then the stock prices go down. Because of this, the second lot tends to be less emotional investors, like Monty. He reacts and goes to sell his stock, which creates more selling pressure and increases the number of sellers in the market, due to which the share price keeps falling further. Seeing this, even those who are a little too emotionally strong, do panic selling, and the market touches its bottom. And then only emotionally strong people like Jack hold their stocks or do more buying at such times. So because of this virtual cycle, the market touches its bottom. Now this cycle works in the same way not only in the stock market but also in the entire economy. Where people don't spend much for fear of bad news, stop shopping, thinking that what will happen in future, whether they will get salary or not, or how much inflation will increase. The effect of which is that the profits of the company are reduced and the company fires the employers for cost cutting even if they don't want to. So those who do not have jobs, they will not spend much anyway, but when this news is spread in the market, then other people who have jobs, who are emotionally strong, also reduce their expenses. Due to which the condition of the company ultimately worsens and they have to fire even more employers. Or some company even shuts down due to continuous loss, due to which people get more scared, and if people keep reacting out of fear for a long time, then soon the country goes into economic depression. Due to which neither people have jobs nor money to spend. So in this situation, it is the job of the government to take some action quickly, so that the country does not go into depression, and recovers quickly. So the government usually prints more notes at such times, or reduces interest rates, so that with those newly printed money, they help the struggling people, or revive the closed companies so that that company becomes successful again, and the economy grows. So something like this happened in 1929, when US came under the grip of recession. The government did not take any step at the right time, due to which almost the whole world remained in depression for the next 5 years. So that's why today's government has become smart, and it starts taking action due to the fear of a slight recession. But printing more notes and reducing interest rates is like a type of injection or a bottle of glucose, which is given to a country struggling with recession. So whenever a country recovers from recession, the government gradually increases its interest rates and stops printing more notes, otherwise it has other side effects. So in the same way, at the time of 2008 market crash, the US government reduced the interest rates to zero. But they have not increased that at all, which means that the US government was surviving and growing on injections for the last 12 years. As you can see in this graph, at the time of 2008 crash, they had to reduce their interest rates, so that people would spend more, but then they never increased it properly. So this is what Charlie Munger was calling wretched excess, that is, the US government has been playing with fire for a long time. So now the question arises that why the US has not raised its interest rates back. So the answer is that the central bank always thinks long term, which is correct most of the time because it leads to proper growth of the country and GDP, but their decisions sometimes do not grow the economy in the short term. And on the other hand, politicians usually think short term, and they also have some powers. Politicians use expansionary and high-growth policies for the benefit of their upcoming elections, means they offer injections and glucose bottles to the country, so that people feel that the country is growing, and politicians get votes. But then it has a side effect in the long term. So first of all, it is important for us to understand that this recession and market crash in the market will keep happening, because there will always be a fight between the politicians and the central bank, and that's why we should always be prepared mentally, financially, and emotionally, because it is a part of our economic system. So friends, now the question arises, what should we do? So the answer is that most of you are in your 20s and 30s, so most probably you are saving now, and you have enough years to complete your career and retire. Basically you would be in your wealth creation phase right now. So if you have created an emergency fund for yourself, then you should be really happy to see market crash or hear the news of market crisis, because right now you are in your buying phase, and we all know that we should buy stock at low price and sell at high price. So when you will retire or invest a good amount, then if you feel tension after hearing the news of market crash, then we understand its logic, that you cannot take advantage of market crash at that time. But right now, if you are in your 20s or 30s and you get to hear the news of market crash, then it should be good news for you in a sense, because there is a sale where you can do a lot of shopping. And if you invest smartly in your 20s or 30s now and invest in quality stocks or index funds, so because of the power of compounding, you can build a decent dividend income portfolio many years before your retirement, as you won't have to worry about the moderate ups and downs of the market. Because then you will continue to get passive income without selling stocks, which means you don't need to take tension about market crash now, nor will you need to take tension after retirement. So friends, now we come to the most important part of this video. We will learn step by step how you can take advantage of market crash. So the first step is to stay updated with the news. It is not important whether you watch the news or not, but at the time of market crash, you should watch the news, so that you can take advantage of the right opportunity. Step 2, build a strategy. Because no general goes to the battlefield and makes strategy, strategy is always made beforehand. Because if you take a decision in haste or based on emotions, there are chances that you will mess it up. So make a strategy now, how much emergency fund you will need maximum, and also decide which type of stocks you will invest in. Basically you have to make a watch list, which stocks will you buy and at what price level. The high quality stocks go down for a short period of time and then their price recovers quickly. That is why you have to make a strategy in advance so that you can take advantage of the market crash. Then the third and the most golden step is that, if you know that you will not be able to handle the ups and downs of the market, and you will not be able to buy when the actual stock market crashes, then you can set up SIP. Because as we all know that we have two ways to invest, one is lump sum where you invest a large amount at once, and the other is SIP. If you do not try to time the market, or you cannot give much time to the market, then SIP is best for you. Because in SIP you buy at every price, then your price becomes average. And the most interesting thing here is that when you see the signals of market crash, you can also set multiple SIP. So this video ends here. If you like this video, give it a thumbs up, and share it with your friends. For more videos like this, hit the subscribe button, and remember to click on the notification bell. Thanks for watching.